Hello and welcome. My name is Christoph and I want to speak with you about the corona crisis and its impacts on the financial markets. We have seen some very serious movements in the last couple of weeks, and a lot of private investors are unsure and uncertain what to do with their portfolios. Is it too late to sell, or is it maybe a good time to buy? We will have a look what happened in the last couple of weeks, and we will have a look what that could mean for their own portfolio. But first of all, a small risk warning. This is obviously no direct investment or trading consultancy and can't replace these consultancies. You are not supposed to trade or invest solely on this information. So please just recognize this as a personal opinion and also get other information before trading or investing. So please have a look in a quiet second and read through this risk warning, and we get a head start what we will speak today about and what we will possibly not speak about. So we will have a look what the markets have done in the last couple of weeks and why they would have done so. So at least as long somebody can tell you this, because I need to disappoint you at this stage. I'm also no magician, and I don't have a crystal ball at home where I can predict the future. We will compare this crash, what we have seen in the last couple of weeks, to former corrections and also to former crises, especially the new economic crisis and the financial crisis. So the two crises we have seen in the 21st century. We will have a look what's different and what's similar. We will therefore have a deeper look at the Dow Jones, the Euro Stoxx 50, the FTSE and the German DAX. We will also have a look how they might have reacted relatively. We will also have a look at so-called safe haven assets, so especially gold, what they were doing during these crash days and if they are an option for our portfolios. We will have also a look at potential scenarios, how the situation might progress in the close future. What we will definitely not speak about is the virus itself and its medical attitudes and anything else what is not in my area of expertise. So we will speak solely on financials and about the financial markets. But first of all, you might think yourself why you should listen to myself. This is obviously your choice, but I want to tell you a few things about my person. So as I said, my name is Christoph. I'm from Germany. You might have heard it in my accent, and I would like to excuse myself for any minor mistakes in my English, but I think the relevant information is still possible to transfer. So I have passed all 3 exams of the Chartered Financial Analyst course. That's a very well-recognized accreditation, a global accreditation in the investment industry. I have a university degree in banking and finance. I have taught more than 10,000 students in the areas of financial trading through live webinars. But to be honest, that I have done in German, my mother language. So it's a bit different, it's a bit new for me. Yeah, besides this, I was heading the German department of the Academy of Financial Trading and the Shaw Academy for almost 3 years. So they are big global players in the educational space. Besides this, I have worked in retail banking, private wealth management, and institutional investment management. So I would say I have a good idea of the needs and the views of different kind of investors. And I have worked in different countries, Germany, Luxembourg, and Ireland. You will see quite fast that Private Investor is a new YouTube channel, so something I'm building up at the moment. So please allow me to say a few words what is special about this channel and what I would like to do with it. The Private Investor channel should provide, or in this channel I would like to provide tailored information for private investors, but they should still be from a qualified and independent source. So there is plenty of information out there, but some of it is just not good enough and other the other parts of it, they are just not independent enough. So for me, it's very important that you understand that there are a lot of parties, they are not free of conflicts of interests. So this might be your banker, this might be your broker. They can tell you information, they can give you educational content, but it will never be free of conflicts of interest because they earn money if you trade. So for me, it's important that private investors also get some information what is free of conflicts of interest. So I don't get any money from nobody. So there are no conflicts of interest. But enough from the introduction. Let's have a look about the most recent developments in the financial markets. So what happened with this corona? Just a really short snapshot to build up the base. What happened for people who might not have seen this in the news, what is almost impossible these days. Nevertheless, let's have a quick look before we look at charts. We had some first corona cases in China in November and December. In the beginning of it, there was not sure what kind of virus it is. Then in January, what is actually not that long time ago, we had the first deaths and we had the further spread of the coronavirus with individual cases, but we had a spread. So especially Japan, South Korea, Thailand and the US saw first corona cases. Then in February, it continued to spread. We had the first cases in Europe and South America. And especially towards the end of February, we saw these first spikes in Europe started to go on there from Italy. And then since the beginning of this month, we unfortunately saw, we are still seeing this exponential growth in Europe and the United States. In China, officially, we don't have new infections. I say specifically officially, so that's the official news. But we see very tragic progressions in other countries, especially Italy and Spain. We see there what happens if a health system is overwhelmed. That's why we saw also very serious lockdowns and measures from governments all over the world. I also wrote there the current status for the time when this video was made. Obviously, a video is not something you make within a minute. So the recording today is on the 25th of March. Nevertheless, for the most data in this video, I will use the 24th of March as a base because I needed to make a cut at one stage to use the courses and prices to make my calculations and my analysis. So based on the 24th of March 2020, there were approximately 410,000 infections globally and 18,000 deaths. So that's without saying any more about this. We see this all the time in the news, and everybody, I think, has enough sources to go further into this developments if he or she might wish to do so. So let's have a look at the markets. Let's start, sorry, I'm a bit home biased here, so I start with the DAX. That's the German stock index with the 30 biggest companies depending on the revenue. So what happened in the DAX? Screenshotted here a chart over the last approximately 5 to 6 years. I also, you see in the right top corner the information, what were the high points in this timeline and what was the low points. And that is very important, because if we look at the last 5 years in the DAX, so we had the historical all-time high in February in the DAX. So if you take the last 5 years and look what is the highest point, it was almost 14,000 points. This is also the all-time high of the DAX. On the other side, then we saw the crash. or middle of February, we start this movement to go on. And we saw the low of this movement, so the floor until now, we have to say, on the 16th of March 2020. So that was approximately at 8,250 points. At the current price, as the closing price of the 24th of March, was 9,700. So we saw some serious recovery afterwards in this market. That means we had a max loss of around 40%, and the loss is still until today almost 30%. The 1 month performance is minus 23%, and the 3 months performance is minus 26%. Yeah, so until now, as I said. So that's enough for the moment. So we saw a total loss around 40%. And we saw some recoveries afterwards, especially this Monday, where we had like 10% plus in the DAX before every small recovery was sold off straight away. But more about these behaviors and these patterns in the market later on. Let's have a look at the Euro Stoxx 50. So the European index, there we have a very similar picture. So we have the high in February, we have the low in March. Also, again, over a 5-year period. So very, very similar. You see almost the exact numbers of 40% minus as a total loss, and the loss until today around 30%. I need to note here also that the companies which are in the DAX, they are also in the Euro Stoxx, or a lot of them. Then let's have a look at the FTSE, so the English stock index. Here it's a bit different, because here we see the high not just in February, we see it in 2018. So if we take the last 5 years, we see the high in 2018, and we see the low now in March with around 5,000 points. But the losses are very similar. The max loss is also around 40%, and the loss until today around 30%. Before we had quite a bit different development in this index, especially because of this Brexit story and the uncertainties we have seen there, especially last year. Then last but not least, let's have a look at the Dow Jones, so the American Industrial Index. It looks also very similar. We had the high in February, but the low over the last 5 years was not in March. It was even lower in 2015. So what I did here, I calculated also the 1 year max loss. And there you see that it's quite similar to what we have seen in the other major indices. So yeah, here with minus 40% and minus 30% until today. And also the performances are very similar. So what we are seeing is that the markets are moving very, very simultaneously. That's something very typical for a crash, what we will see in a few slides. Here also a bit more close picture to the Dow Jones, where we see all these massive day candles. Yeah, so I don't know how aware you are of these candles, but a red candle means always falling courses, and a green candle means always rising courses, and always based on the day's closing price. And there we see that in the beginning we saw a very strong movement and a small retracement, what was used straight away. So whenever we had a day with positive effects, it was used straight away to sell off more. So the investors used these recoveries to exit the market and to leave the market. And what we see now in the last couple of days, that we eventually have a row of positive days. So not just one retracement day, we have like three days now in a row, and that shows that we get a bit less volatility. at least with the information we have at the moment. So that was the situation. So not too much new here. Let's have a look at what that means. Here I presented to you also the numbers, so the max losses. Here also always the height, the 1 year low, because of the special situation in the Dow Jones. And I also included the MSCI World here. What is very interesting that you have actually the smallest losses in the MSCI World, what shows you that the more diversified your stock portfolio is, the better it performs here, especially because the diversification between the countries. But what you potentially will notice, the more the coronavirus will spread over the world, the closer these numbers should, at least theoretically, come to each other. So we see all the major markets, they are very, very close to each other. We see the max losses so far. If you took the highest point to entry and you took the lowest point to exit, you destroyed like 40% of your money within 1 month. If you didn't sell and you entered at the highest point, you are now around minus 30%. To understand the situation now, we first of all need to understand the situation before Corona. So we saw all-time highs in almost all asset classes, be it bonds, let it be stocks, let it be real estate. In almost all asset classes, you saw very, very high prices. We saw also that bad news were almost ignored completely. That's very, very typically. We saw that small pushbacks, if there were some, because it's not that easy. If bad news are almost ignored completely, you see euphoria, and small pushbacks were immediately used for market entries, especially from investors which are more professional. We could also say that the financial markets were quite inflated with money out of more than 10 years of expensive monetary policy all over the world, but especially in Europe. So money is very, very cheap, and we saw more and more money also flooding into the financial markets. Not last because, especially for institutional investors, it costed money to or it costs money to keep the money with the central bank, or to keep the money in safe assets like the German treasury bonds. So we saw that the return risk ratios shifted in all asset classes. Let's take, for example, the bonds. Yeah, in former times it was possible to get like 5, 6, 7, 8% in a normal senior bond. So a bond is essentially a loan to a big company. Let's keep it like this. So it's a credit which is traded on the financial markets, and it has like a coupon. A coupon is what is paid out annually as an interest rate. And yeah, with the decreasing interest rates, also the returns and coupons on these bonds were decreasing. So for banks and institutional investors, that meant so either they could increase their stock exposure, what means another risk and a higher risk, or they could go for more riskful assets, or they could go for bonds with more risk. So they could go for so-called junk bonds with bad ratings, or they could also go for structured bonds like convertibles. But so that the return risk ratio shifted in all asset classes against the investor. So the alternatives to stocks, what especially the institutional investors need to have in place for a diversified portfolio, they were getting more and more unattractive. So in small, you potentially see this with the housing prices, which were rising in a lot of countries and places in the world. But not especially because the people they are living there, more because of investors investing their money in the real estate market. So that was a situation and is a situation for institutional investors, what is quite challenging. Yeah, so they have the responsibility to get some return for their portfolio. For example, a pension fund or a bank, an insurance company, they need to work with the money and they can't allow the money to decrease, at least not over a long term. So that was the situation before Corona. So let's have a look now at typical correction patterns through unexpected events. Yeah, so there you have the markets and then you have like the usual events. So that might be a quarterly report from a company. They are reporting their numbers. That might be disappointing, that might be okay, that might be very, very good. So depending on this, you see smaller movements, bigger movements, depending on the numbers. But what really is moving the stock markets regularly are unexpected information. Yeah, so information which comes to the market what nobody was predicting. Then what you often, let's take as an example, you remember potentially Fukushima, the nuclear power plant in Japan, where we had this catastrophe. We saw very, very high price movements. Yeah, so we see in these situations the market prices to overreacting, yeah, on this new information. We see a typical, we see cash going out of stocks, we see cash going on volume going into safe haven assets of the likes of gold and the US dollar, for example, or treasuries. And on the next days, you see the market participants, they are rethinking the situation. So they are estimating how bad the event is essentially for the global economy. Is it big enough to influence the global economy? And in the most cases, the answer will be no. Yes, you will have often a negative impact, but it will not have a massive effect on the global economy. So that's a correction. You might see a few days of negative prices, besides the normal volatilities you can see in the market. Yeah. But then you see, okay, the market is getting used to the new information. Yeah, and especially more experienced investors and professional investors will use these prices then for entries. And that's later on the reason why the prices are coming back. So you have spikes in volatility, but they are reaching an average level quite fast. So that's a correction. Yeah, you have an unexpected event and you have a movement in the market, but that's normally done after a few days or a few weeks. Then you have crash patterns. And I speak of a crash right now because of the extent of the movements and because of the patterns. And what are these patterns? For me, very typical for a crash is that panic is dominating everything. You see volatility, so the volatility is used as a risk measure in the market. Volatility is a statistical number what shows you the deviation of the expected value. And this volatility is shooting up in a crash situation. Maybe, or you might have heard also from the black swan situation. So that is this big but very, very rare event which destroys everything. Yeah. So a black swan is very rare. That's why the name. So we have this black swan scenario. Volatility is shooting up and it stays on these extreme levels for several days and weeks. So it doesn't come back as fast as with the correction. You don't see any rationality in the market anymore. Yeah, the market goes away from its normal behavior in an extent what is almost not believable, especially if you never have seen a crash before. So the relative performance you normally have, yeah, like 1, 2, 3 maybe 4%, and 4% is already quite a high number. But the performance is leaving this range significantly. So you see day performances of around 10% instead of 1.5%. Yeah, you see that the markets for derivatives, especially options, is trying out. So first, normally the spreads are widening, and then you don't see any trading there at all. You see that normally extremely good news, so extremely good needs to be understood regarding the economy, of course, not regarding a humanity perspective. So extremely good news for the economy, they are completely ignored. So you have these massive packages from governments, from central banks, and they are ignored completely. They have no effect at all. Yeah, you saw some retracement days where it was written, yeah, that was because this package. Yeah, but the other 10 packages before, there was no effect. It's very, very easy to say a movement was because of an event afterwards. You can just search what was happening this day and say, okay, that was the reason why you had a recovery. But I think it was more because the markets were so extremely oversold, so that the market starts to recognize this good news, but also the good news from before. But in the first moment, they have no effect at all. So you think, well, that's massively, that's correct how the governments are reacting with these bazookas. They are going into the war against this virus, and the markets just ignore it completely. You see this free fall, what is for sure also more drastic, because we have nowadays this automatic trading. We have risk limits of institutional investors, so we have higher regulation for insurances, for banks. Yeah, so they need to have equity for their assets, for their portfolio, and the risk exposure is normally measured on numbers which are based on the volatility. So that means if the volatility goes up and they still have the same portfolio, their risk exposure is increasing, and their risk budget is disappearing. So an institutional investor could actually be forced to sell. Also, he didn't do anything in his portfolio, just the prices of the portfolio did change and the volatility of the positions change. We will have a look at volatility measures and their development also in a few slides. What is also very typical for a crash, that all industries and all assets are decreasing. So it's a complete sell-off. The correlations which are preyed with the portfolio management, they are decreasing, they are disappearing in the situation where you need them the most. And that's a fact. They are disappearing in crash situations, but they will come back to your portfolio. So if you are using it, it's still a very, very good idea. Portfolio diversification works. But in the situations where you need them the most, they are first of all disappearing. In a crash, everything is sold off. So money is not going from one asset class to another asset class. Money is leaving the market. It goes into liquidity. Yeah. What is also important to understand, how later on the markets can rise very fast again, because the investors, they are sitting on mountains of liquidity. So you don't see differences between the asset classes. You don't see differences between the industries. I will have examples for both of this. Yeah, and what we also saw in this small chart from the Dow Jones before, that these rare and small corrections, they are used straight away to sell off more. Yeah, for the people who are still in the market, they wait for the small increases in prices to sell off their positions. You see a lot of scare in the market. So let's have a look at this volatility. Sorry, I'm home biased here again. So we are looking at the VDAX. So it's essentially the volatility index for the DAX. It shows you the expected volatility for the next 30 days. And what I did now, I made a bit of analysis here and had a look what was the volatility, or what was the average of the volatility in 6 months before all of this corona situation started in this extent. So I took 1st of August until 31st of January, where we actually had already these developments in China. But nevertheless, I took the 6 months, took an average, an arithmetic average, what was 15.82. So that was the average volatility in the VDAX. What I did now, I took this 1 month between the high and the low, I took this month and also took an average there. That was 37. Yeah, so in this 1 month, we had an average in the volatility already from 37. That's a plus of 137%, or the factor, it's more than double of the let's say normal volatility of the market before. Then what I did, I took the last week. So from the 24th, 1 week backwards. So from the 18th of March until the 24th of March, we had an average volatility of around 70. That's a plus of over 300%. That's more than 4 times of the normal volatility. What I did then, I took a week before. So that was the week where essentially these new low prices where we have seen this new low prices. Yeah, there we have 73 almost. Yeah, that's very similar to last week. Nevertheless, and the current one. So as of the 24th of March, it was 54. So coming back a bit, but still extremely high. Yeah, and that's something very important for you. You need to be aware of that. Even if the prices are coming back now, we still have a lot of volatility in the market. And volatility is the most significant and most relevant indicator for risk in the industry standards. Yeah, so volatility is used for the risk models. So volatility is very, very important, and volatility is also often referenced as a fear indicator for the markets. So don't let these recoveries of the last days cheat you or trick you. So we still are at a plus of 242% to the, let's say, normal volatility what we have seen in the markets before. So it's still almost 4 times the volatility. So whatever or to whatever conclusion you come after this video, you must be aware of that the volatility is still very, very high. Then I said that in the normal safe haven tendencies didn't work. So let's have a look at gold. Yeah, we see here the approximately 1 month, 1.5 months, and we see this crash. Yeah, we see what is happening. Yeah, we see that the markets are falling. First, gold is also sold out, and then we see that money is going into gold for a while, and then the more the correction is becoming a crash, that also money is leaving gold drastically. So we see that first of all the normal safe haven tendencies are working, then the market is switching to a crisis mode, and the sell-off is extending to the asset class of gold, but with a timely delay to stocks. And then what we saw now in the last few days, where it's getting a bit calmer now, and something like normality is coming back slowly. Yeah, and you see that money is going back into these asset classes, because liquidity reserve is especially costing institutional investors money. Yeah, you see this also in the performance. You don't have like big pluses in gold like you would have, or you might have expected it. Then let's have a look at the Bund future. Bund future is the indicator for the treasury bonds of Germany. Sorry, also here a bit home biased. Nevertheless, let's have a look at the day of the high of the DAX. Where we had a price of 174, and the low of the DAX here we have a price of 172. Nowadays we have a course of 170. So minor changes, but also not rising as you would expect from a safe haven asset, that it was rise when the stock markets are decreasing. Yeah, so we can also not see that. Let's have a look at different industries. I took here 3 companies from the DAX. I took Bayer, a pharmaceutical company. I took Lufthansa, an air transportation company, and I took the Deutsche Telekom, a telecommunications company. So 3 companies from 3 different industries. I would say you would expect that the pharmaceutical industry is potentially benefiting from such a situation as we have. You would expect air transportation company like Lufthansa to massively lose in such a situation, as almost all the flights are cancelled, almost all the borders are locked. So you would expect Lufthansa to suffer heavily. And then a company like Deutsche Telekom, you wouldn't probably expect a too high effect, because it potentially works like normal. But of course, you could argument that more people are working from home, that maybe there you need more services, so that it potentially is a bit better. But let's say you don't have major effects. Now let's have a look at the performances, and you will see that the 1 month performance of all 3 stocks look almost the same. So, and that's what I'm saying. There is no differentiation between the different industries. So the market is pulling everything in his reach. He's pulling, or it's pulling down with itself. So you don't see a major outperformance for different industries, but that could be a chance for you later on to stock pick, to potentially overweight specific industries where you think they were penalized too much in this crash now, and that they should recover more than maybe others. But there you see that the correlations I was speaking about, they work less and less the more the market is in a crash mode. Then what I did, I compared the situation today with the 2 major crises we have seen in the century. So one time the new economy crisis, and the other time the financial crisis, just to see what kind of maximum losses are realistically. Yeah, and there you see that from this minus 40% what we have seen, there is still air on the downside what we could see. So if you are planning to hold your investments and your portfolio, you should be aware of that you could see another or other losses of around minus 50%. That's something you need to be aware of. Yeah, it's not untypical in a crash to see numbers like this. And there you also see where we have been, like not even 10 years ago. In the different indices. These are levels, they are lower than the prices we are seeing today. Yeah, then the outlook and the options for actions, probably the part where you're most interested in. Obviously, we have on the one side, we have a very expensive monetary and fiscal policy, and we have global measures to flatten the curve. Yeah, that massive measures all over the world to limit the spread of the infection. On the other hand, we have this pandemia. We don't have a drug. We don't have a vaccination. That's a matter of fact. And it's very, very unpredictable how far the virus will spread and what consequences this might have for the global economy. Nobody can seriously predict this at the moment. So what I like to do personally, I like to think in scenarios. So I defined like 3 scenarios. That doesn't mean that the scenario will happen in exact this description, but I think something along these lines we might see. So the scenario 1 is that the global measures to flatten the curve are working, and the pandemia is becoming something like controllable, yeah, and that we get like a drug or vaccination in the short term. So that would mean that after 2-3 months of craziness and tragic, the economical normality would be returning. Yeah, that would probably also mean that the consumption is caught up in the second half of 2020. That would be a situation like we have seen it with the SARS virus in 2003. So in this case, the markets could reach their February highs quite fast again. So I would expect in the next 12 months. And I would also think that you have these losses because the people are now at home and the consumption is stopped and the production in a lot of industries is stopped and the working in a lot of industries is stopped. But on the other side, you have these massive packages from the governments and also from the central banks. So that probably would compensate for the gap and the losses at the other side. Then scenario 2, that the global measures to flatten the curve are not working. That's more like the worst case scenario, and that you would not have like a drug or a vaccination. That's obviously no situation we would like to be in, not from an investor's perspective and also not from a human perspective, but nevertheless that's a scenario what can happen. As I said, I'm also not in a position to make any predictions. I'm just thinking about what could be the scenarios be. So we would probably have overwhelmed medical systems. We would have probably further lockdowns. So the economical normality would just return once we have a vaccination. And the normal process for vaccination, we should estimate with around 18 months. That would mean we would have, or we would continue to work with this emergency economy, what we see nowadays or at the moment in a lot of countries. That would probably mean we would fall in a very deep recession. And in this case, my guess would be that we see prices of the likes of 2008. To be honest, because in my opinion, the prices at the moment they are pricing in a low recession. So we are not pricing in a deep recession in the prices yet. That's scenario 3, and to be honest and open, that's my favorite, because I often think the truth will be found in the middle. I think we will see strong limitations throughout 2020, but I don't think that we will see them in totality, and I think we will see them in waves and episodes. So I think that we will see effective medication and fast-track vaccination in Q4 or Q1 next year. I think that strict measures are released, so that we will see that an improvement in the situation through the measures we are doing at the moment, and that then the measures are more loose are loosed by the government, and then in other waves we will see similar measures again. So the economy is working to an extent between the waves, and then it just works in this emergency mode, and it works normal, then in the emergency mode, and so on. I think in this case we see at the moment quite fair market values. Then I would think that we see like a soft recession, a light recession, and therefore we would have quite fair values with these minus 30 to minus 40% what we have at the moment. So what should we do with this information now, with these scenarios? As I said, my favorite is option 3. You need to decide for yourself what is your favorite. So what should you do with your portfolio? I would recommend you to ask yourself the questions: do I need money short or middle term? If yes, this money should have never been in your stock account, and potentially you need to think to get some money out of it, but also with the information I give you in the next few slides. Then you should also thinking, am I willing to carry on with all these positions long term? Because the long-term perspective, especially in stocks and in your portfolio, is very, very important. Otherwise, you're moving more into trading, and then you should also think about if that is what you want to do at the moment. Then besides the willingness, you should also question yourself honestly if you think you can handle it psychological if you lose another 50%. It's always different to read it in a book. Yeah, it's a difference if you see 50% of your money disappearing from within a few days. Yeah, so I think the most of you made this experience in the last couple of weeks. Now question yourself, can you handle to lose another 50%? And then also ask yourself, what is your liquidity reserve? Maybe make an Excel sheet about your money, about your assets, and have a look what part is stocks and capital markets playing, and is this a percentage you can live with? And do you want to live with? Or do you want to increase it? Do you want to decrease it? But have a look. Then there are three possible outcomes you might feel. Yeah, when you ask yourself these questions. You might feel unconfident with your current positions. You might feel confident as it is. Or you feel confident and you even see chances in the current situation. Myself, I'm more in group number 3, but everybody else, as I said, everybody needs to decide this for him or herself. Independent of the options, please have a look at all the information I have written here. You will see that there is much more information on this slide, but this is especially for you, that you can also read it after I have finished this video for your specific situation. But I would highly recommend to you to read all the 3 slides. If you feel unconfident, create an exit strategy. If you feel really, really unconfident that you can't sleep, cut your positions immediately. Yeah, you will realize a loss, but do it. Yeah, it's not worse to go to your psychology or is stealing your sleep. Yeah, cut the positions and realize the loss. If you are okay with the position, but you think like, yeah, but I would like to get rid of it, then use market recoveries like we had them on Monday to reduce your exposure in the positions. Nevertheless, if you do so, if you sort out your portfolio and have a look there, always question yourself, is it rationality what is leading you, or panic? Panic is a very, very bad advisor, not just in the financial markets, by the way. And before you make these decisions, ask yourself, do you still believe in the positions? You should not sell positions now short term if you believe in them long term and you bought them originally long term. Yeah, then it might be better just to don't watch the courses and just hold it if you still believe in them long term. And ask yourself, how do I feel when I sell, or if I don't buy, I sell them? Yeah, but essentially you should feel confident with your positions. But you still need to be aware of that nobody is happy to see his money to decrease around 50%. It's more how you handle this information for yourself. What is also very important, that you question yourself about your financial exposure. Yeah, some people, it's easy to have a high stock quote in situations where the stock markets are rising constantly. In situations where they are falling, there it's where it's hard to have the stock quote. That's why you should question yourself if the percentage of your total assets is appropriate for your personal, individual financial situation. Have a look, read it, and make your decision. Then if you feel confident as it is, so if your portfolio was built long-term, diversified, you have the correct risk exposure, that's very good if it fits your individual financial situation. Then accept it, note it for you, especially for the moments where the markets might crash. Yeah. Try to get away from the markets a bit and review in regular but longer periods. Yeah, don't look every day to get nervous when there's a minus of 10%. Yeah, it might be the case. But still, you should think that all the outcomes of the scenarios is possible. But I think you also have like a upper limit of this 18 months. I think with the medical standards without being a doctor, but I think within 18 months we will have a vaccination in a situation where we have a virus what is influencing so many lives and the public at the moment. Continue with your ETFs. The strengths of ETFs and investment plans, investment saving plans, they are playing out right now. Yeah, the higher the volatility, the better for such an investing plan. Yeah, so you enter the market now gradually at lower prices, what is pushing your average price down. Then if you feel confident, be careful to not feel overconfident. But also continue existing ETF plans, investing plans, maybe increase them or set up new ones. If you have higher liquidity reserves, what you want to invest, think about to split them. Don't get too greedy. Yeah, that's also very important. Don't get overconfident and don't get too greedy. Yeah, because you might see, oh, now we are at like 9,000 points in the DAX or 10,000 points, but we might be back in a few months at 13,000 points. I could make a lot of money here. Don't get greedy. Split your liquidity reserve to not shoot all your ammunition, because it can happen that we see very, very relevant down movements where you also want to have liquidity to invest more into the market. And last but not least, a quotation from Warren Buffett. Be fearful when others are greedy and greedy when others are fearful. Always stay rational. Don't let panic be your biggest advisor. And yeah, then some very last information about myself and the channel. Please ask all the questions you might have in the comment section or through Patreon. There I also have an account. It's linked in the description. Follow my YouTube channel here. If there is demand, I'm happy to bring up an update on this video and the situation every 1 to 2 weeks. Just give me a feedback and I will do so. Give me also feedback about other topics you are interested in. As I said, it's a new YouTube channel. I'm happy to make also videos about more general topics about financial markets. And yeah, I would be happy about comments, sharings, clicks, everything what is supporting it. And I hope it helps every private investor. Thank you very much for your time. And as I said, let me know if there are any questions in the comments or through Patreon. Thank you very much and goodbye.